Hello, guys. Welcome to day, I think it's 15 or 16. I don't know, but we're on the third week of the free trading academy. So, welcome. Hope everybody has been enjoying it so far. So, you guys are going to notice the change of thumbnails, the change of colors in the thumbnails. It's going to be orange. This is going to signify that we're entering into the intermediate part of the trading academy. Don't be like scared or whatever. It just means that we're getting into concepts that are gonna blend everything together. Okay, so we're entering intermediate stuff. So if you haven't really watched the first 2 weeks of this like the free trading academy, go back and rewatch them, redo the homework in those first 2 weeks, and then come back and start this intermediate section now. Because when you start this and you rewatch all of that and you do the homework twice, 3 times, 4 times, you really dissect these charts thus far into this, up to this video. What you guys are going to learn here are going to be different concepts like this fair value gap FVG, which is what we're going to be talking about today. You guys are going to learn about order blocks, breaker blocks this week, like all the concepts that you really just need to know. You don't need to know about these other things. We'll talk about it later in the academy, but yeah. So welcome to the day, whatever it is. We're in the third week, start of the third week. We're going to be talking about fair value gaps. Again, if you haven't watched the first 2 weeks, go rewatch them, go redo the homework, and then come back to this one. So fair value gaps, what are they? Why are they important? Why do we need to know them? So FVGs are probably going to be the backbone. Besides liquidity, it's going to be like the backbone of almost every strategy that's going to be taught here in the academy. Fair value gaps are very, very simple. They're just gaps left between the candles, very, very much like this. We'll have 3 candles, right? We'll have 1 and then 2 and then 3. So it's pretty much the high of the first candle and then the bottom, the low of the third candle. So in this case, this is going to be a bullish fair value gap, a bullish FVG. The important part is that it leaves a gap behind, right? We skip over this candle and we go to this candle's low. Okay, so it's going to be the low of the third candle and the high of the first candle. Okay, and then there is a gap right here. Oftentimes, this is a very important thing. Oftentimes, I need you guys to wait for the third candle to close because sometimes you will have the third candle make a big wick like this, or even you'll have like the body. Oh, dang. You'll have like the body go down like this, right? And then we won't have a fair value gap. We won't form a fair value gap. This is not a fair value gap. A fair value gap, you'll notice it right now when I show you examples. You're going to have these little gaps like this between the 3 candles, just like this drawing right here, right? And if you're looking for a bearish one, it's just flipped, vice versa, right? It's going to be the low of the first candle and then the high of the third candle, okay? You're going to have a gap. Now, the point of these fair value gaps is these fair value gaps can be utilized and used for entries to take you up to the drawn liquidity because a fair value gap can be used as a form of drawn liquidity, meaning that, you can use fair value gaps as targets. Like, say if you were in a position here and you were shorting, you could short down to a fair value gap. That is a point of interest. That is a drawn liquidity in a sense, right? These can be used for continuations to get up to a drawn liquidity. So say you have, your external draw and then price comes down to a fair value gap. You could use this potentially to get into the marketplace and take it up to the external draw. Okay. So it's pretty much a gap left behind where orders is pretty much where market is going to rebalance. Okay. Another name for fair value gaps are going to be specifically a bullish one is going to be BISI. Some people like to call it imbalances. And then for the bearish one, they're going to be called SIBIs. Okay, this is bearish, right? This is bearish fair value gaps. These are called SIBIs. These are just different names for fair value gaps or FVGs. You'll see other people like on social media or whatever call them SIBIs, BISIs, imbalances, gaps. It's all the same thing. It is just a fair value gap. Okay, these are just different names. Okay, so a BISI, remember bullish FVGs, that's the nickname for the bullish ones, is called a BISI for fair value gaps. And then SIBI, that's the bearish one. What it stands for, the BISI one, it stands for buy side imbalance, sell side inefficiency. And then the SIBI stands for sell side imbalance, buy side inefficiency. Okay, it's basically just rebalancing, right? The market is rebalancing in these fair value gaps to potentially go to where the drawn liquidity is, right? Wherever the market wants to go. Okay, so that's pretty much a fair value gap. Let's get into the chart here and I'll show you some examples here. So right here, you'll notice that, price comes into this 1 hour fair value gap. And if you guys already notice, if I mark out my fib, what are we in, right? We're in a premium market, We're in a premium market, so this is a premium what? Premium fair value gap, okay? Premium fair value gap. Another thing is right here. We also have a fair value gap right here. And one thing I forgot to actually mention is you want to make sure that body, like if you're looking to take price to a fair value gap, or you're looking for entries in this premium fair value gap of this external range, and you're looking to short it down to this bullish one here, one thing I do want to emphasize is the bodies of the candles when they enter these fair value gaps. Okay, so if this candle right here would have closed a body above it, this would have been invalidated in my eyes. Okay, wicks do the remember this, wicks do the damage, bodies tell the story. Okay, wicks do the damage, bodies tell the story. Okay, remember that. Wicks do the damage, bodies tell the story. So if the bodies closed above this fair value gap here, I would have assumed that they may have wanted to take this liquidity up here, right? The Friday's high right here on this external range. Okay, it could wick up, it could definitely wick up or wick down if it was a bullish one, right? So this one right here, this bullish one right here, has to hold, in my opinion. It cannot close bodies below it, because if it closed bodies below it, it's going to be invalidated in my eyes. It can definitely wick. It can leave a long wick or just wick below it. As long as it's closing bodies in here, then this has potential to take it higher up to this drawing liquidity. Does this make sense? Forgot to mention that when I was showing you guys the drawing, but these are basically fair value gaps right here. Okay, right here. There's another one right there. There's one right here. One more thing that I want to mention that I did not mention is that you can use these fair value gaps as inverse, right? Every single concept that we're going to be talking about this week is they have an inverse concept to them, meaning that you can reverse them, right? So this is a bearish fair value gap, okay, that caused a new low. So it gets invalidated because we closed a body above it. So as soon as you see a body of a candle close above this bearish fair value gap, you could potentially use this as an inverse, meaning that it will get flipped, right? This may be used as resistance. Now it closed above. Now it can be used as support. So as you guys can see, this is being used as support. It's supporting price to go higher. And then over here, yeah, we closed a body below it, but then the next one closes a body back into it. And then again, close above it, and then we shoot up, right, to take out these internal highs, these internal relative equal highs right there. Right, I forgot to mention that, but for now, I just want you guys to jump on your charts, start looking at fair value gaps, and specifically look at fair value gaps that are in premium or discount of your external ranges. Okay, so you've learned ranges, you learn what premium and discount is. Now, what I want you guys to do is go into your charts and then look at fair value gaps in premium markets or discounted markets. And where is your draw on liquidity? Where is that displacement, right? Where are your internal draws, right? Are they relative equal highs, or are they just little swing highs like this? Go into your charts, look at fair value gaps, and look how they are reacting within the discount and within the premium. Okay, that's what I want you guys to do after you see this video. And one more thing with fair value gaps. So for example, right here, right, in this one, so you have your external, right? You have your high right here, your Thursday high, and you have your Thursday low, okay? And you get Friday's price action right here. We obviously come into a premium, right? You don't want to short this one. Why? Because it's in a discount, okay? When you make this swing low and now we're pushing up, we're obviously pulling back. You can mark this out, but you wouldn't want to short this, right? Because what does it go against, right? It goes against our premium and discount rules. This is where you need to practice patience, right? This is where you need to practice patience, okay? You don't want to short right here because it's in a discount of the external leg, right? Sorry, I didn't mark out the Thursday high, but you can definitely mark out that one. But you don't want to short this because it's in a discount, right? This is the last fair value gap that makes that low. We come up, we close above it. So you can use this as an inverse, right? You can use this as support. And look, we make another one in it, right? So this gives you the more reason to look for potential buys to go a little bit higher, at least into equilibrium, at least into 50% into the premium market, right? And it respects it, and then we push up. And now, if you look at this is the last, or not the last, but this is one of the fair value gaps in the premium market, right? It's in a premium market of this external range right here. Even if I were to drag my thing right here, since this is a swing high technically, and this is the one that makes a new low. So you either mark either or because this is a daily range. But as you guys can see, it doesn't change the fact that this fair value gap is in this premium market, right? So look, we wick up, but we close the body within this fair value gap right here. The next one wicks up a little bit, close the body within it. We go down. We disrespect this one. We disrespect this bullish PD array. Sorry, bullish fair value gap. PD arrays are just okay. So some of you guys might be confused, but PD arrays are just like concepts. They're like a group of concepts, right? PD array is just like an FVG. It's like a point of interest. Anyways, disrespects this bullish PD array off this one in premium, right? And this bullish PD array is technically still in a premium. So you don't want to long it right here. You want to look for shorts in this premium fair value gap. And guess what? Starts heading lower, right? Remember, wicks do the damage, bodies tell the story. But that is what a fair value gap is. Go into your guys' charts, mark out your external ranges, and then look at how price reacts to these premium and discount fair value gaps. Again, if you guys aren't in the free Discord, make sure you guys join the free Discord. If you have any questions, I will try to answer them in a timely manner. But hope you guys enjoyed the fair value gap video. Make sure you guys leave a like, subscribe, and leave me a comment. Let me know how you guys are liking the series so far. But yeah, catch you guys in tomorrow's video. Peace out, guys.